the spike in oil prices likely to be short-lived? It's obviously anyone's guess. Odds are good that they're going to be, it's going to be shorter-lived than some are prognosticating, and it's also not going to be an immediate turnaround like the administration would like you to believe. I think the truth is always a little bit in the middle, and there's a fairly major disruption to global oil supplies right now. There's not just the fact that the Strait of Hormuz is closed, meaning ships are having a hard time getting through. It's not impossible. Some ships are getting through. But also there's a bunch of production that's offline as a result of some of these bombings and attacks on oil facilities in the Middle East. So it's going to take some time for a lot of this to work its way through. We've seen a pretty phenomenal spike in oil prices, which ultimately works its way through to gasoline and jet fuel. But it's actually not quite as extreme as you might have thought. And I think part of that is the world's supply of oil is a little bit more diversified today than it was 30, 40 years ago. The U.S. is actually the number one producer of crude oil today. So what happens if these higher oil prices and ultimately higher energy costs to consumers are here to stay for an intermediate period of time, 6 months, 9 months, 12 months? That is different, I think, than what the market is currently pricing. And that would have an impact on, obviously, on consumers in the short term, but ultimately it would have an impact on inflation readings and whether or not the Fed needs to come in and initiate a new hiking cycle. The Fed just spoke yesterday, Powell spoke yesterday, and there's concern that the easing cycle may already be over because of the uncertainty that's likely as a result of higher energy costs. It's a huge input to CPI, and obviously we can't make a determination in 1 week or 2 weeks, but yeah, if this is going to last for months as opposed to weeks, it's going to be an issue. Sort of a follow-up on the previous question, what if that's not the case and what if this ends up being short-lived? Yeah, I mean, there's a very clearly a short-term opportunity that's presented itself with oil and energy stocks having a huge run in a very short period of time, which is sort of the opposite of all the other sectors. So we've seen financials in the broader market, technology, all have sold off pretty hard in a short period of time. So we do have this sort of disparity in where performance has gone the last few weeks. So an investor that's a little bit more short-term oriented might take advantage of that. They might take profits in their energy stocks and rebalance into some of the other sectors and asset classes that have not done as well, such as technology. And that's sort of the most obvious trade, I think, if you're looking to make a trade. Of course, it's all risky because we don't know how this is going to play out. But just in terms of short-term change in momentum, yeah, I think we're potentially at an inflection point as we speak today. It does feel a little conspiracy-ish because what's happened since the war in the assets that you would expect to be most impacted positively by the war have not performed as you would expect. So gold and energy stocks were really kind of rallying for a period of time right up until the end of February when this attack was announced. And so now we're 3 weeks in and gold is down. Oil is, of course, up about 50% since the end of February when the first attack was launched. And energy stocks are positive, but not by very much. For oil to be up 50% and for, let's just say, Chevron and Exxon, for example, to be up less than 10% each over that same period of time, and gold to be down, it's just like sort of the definition of buy the rumor and sell the news. There's a little bit of a mismatch between how bad sentiment is and how not so bad markets are, but it's sort of irrelevant because these sentiment readings that we're seeing do tend to line up with, at the very least, short-term rallies, a relief rally, short covering rally, whatever you want to call it. Generally, a durable, long-lasting bottom is formed when sentiment gets really washed out and there's no one left to sell. I don't know if we're exactly at that level, but some of the readings are indicating that we're at that level. So is it a good time to buy? I think more than anything, it's just not a great time to sell. And I think similarly or conversely, sentiment has gotten overly enthusiastic on energy and oil related stocks. Is there more upside? It's possible. But I think there's just that disparity, that unevenness in terms of comparing one sector to another has probably reached an extreme. And I think also the reason sentiment maybe is so bad when markets aren't that bad is because people, the average investor is overloaded with some of the stocks that have been hot for the last few years, and those are the ones that have taken the brunt of the selling. So I think the average investor is probably hurting more than somebody who's just 100% exposed to the S&P and some bonds, for instance. Should we be concerned about issues in private credit? The fact that redemptions or attempted redemptions by investors are starting to pick up, and some funds, the largest funds that are involved in private credit, are clearly having issues. There's stress on the stocks of companies like Apollo, Blackstone, KKR. Blue Owl is another one that's just always in the headlines in a negative way. Is this something that we need to worry about? The answer is I don't know, mostly because the investor base of these funds are generally institutions and high net worth and ultra high net worth investors. And I don't want to say like, who cares? But these are people who have invested money that they generally can afford to lose. Or they can afford for the redemptions to take a significantly longer period of time than initially advertised. So damage has been done to these stocks already. All the four private funds that I mentioned that trade publicly are all down anywhere between 30 and 50% just in the last 12 months. So damage has been felt by their investor base, and I think it's in a lot of ways it's being priced in. In public markets, we're seeing the debt markets function exactly as they're supposed to. There's plenty of liquidity. Yield spreads are not in any kind of concerning levels. So I think it's headline risk right now. It's something that people are talking about. I don't see the risk of this having any kind of contagion into public markets. I think at the moment it's contained to parts of the market that can afford it. It's a little bit more fun to answer the what could go right question when so much is seemingly going wrong, because there's room for improvement in all of the areas that just got referenced. This resurgence in inflation, mostly due to the fact that oil has just spiked. Interest rates are starting to creep back up. The Fed is feeling and sounding more nervous and certainly reluctant to cut rates. If anything, discussing the possibility of having to raise rates again. War, of course, is a headline nobody likes to see. However, historically, it hasn't been really a negative for markets. What could go right? I mean, we could have a toning down in the rhetoric of Iran and just the Middle East in general. Everybody feels like that's unlikely. And it may be unlikely, but it's also possible. It's not impossible. And we've also seen so much damage in certain parts of the market. Like you highlighted, software stocks, tech in general, financials, home builders are all really have taken a beating recently. So there is room for improvement. There's room for some of these most recently beaten down areas to regain a little bit of footing. And obviously if the rhetoric tones down in the Middle East, then we're going to probably have a ceiling on oil prices, and that will at least provide some line of sight for oil, for energy stocks, for inflation. All of that sort of trickles into what the Fed's looking at and how likely or possible further rate cuts are. I think at the moment it's a little ambitious to think about cuts, but if there's in a relatively short period of time, if there's not ammunition for the Fed to have to talk about hiking, I think that would be considered a good thing. Those are all things that could go right, which is just a little bit of improvement in all of the areas and all of the things that are going wrong as we sit here today.